Happy morning. Hello and welcome everyone. I'm your host Ajay Aditya C, and this webinar is powered by Zoho Books, our smart online accounting software. In today's session, we are going to see how the goods and services tax impacts the different areas of your business. In order to keep this session free of distractions, all microphones save the one used by me have been muted. That said, if you have any questions at any point of time, you can just drop them in the chat box inside the meeting interface, and my team members here will give you the answers. Now that we have set the table, let's get started. The Goods and Services Tax, or the GST, is a single indirect tax that will replace almost all of the indirect taxes prevalent in India, and it will bring them under a single body of legislation. Expected to launch on July 1, 2017, this system will simplify our tax laws, expand our tax base, and remove the burden of having tax upon taxes, which is currently prevalent within the existing system. That being said, nothing comes without a cost. Along with all the advantages that GST brings to the table, it also comes with it a myriad of changes which warrant a complete overhaul of your current business system. This is because the GST affects many aspects of your operations, starting from procurement to distribution of goods to accounting. More often than not, new laws mean new paperwork for you to deal with. Moreover, transitioning from the existing tax system to the GST has the potential to make your operations more messier, especially during the transition period. This is because you have been used to the current indirect tax system, and the current system, as you can see, has different laws across different states. So you are accustomed to operating with this chaos that is being present right now. But then with the GST, things are going to be streamlined across the entire country. And so, because of that, it's going to be a big change coming your way. But look at it this way, it provides you with an excellent opportunity to assess and realign your business strategies while ensuring maximum compliancy with the new tax system. And today we are going to take the first step towards this by analyzing how the GST will affect different aspects of your business. So, be it sourcing, be it the pricing structure you follow, be it your supply chain logistics, your distribution network, or your accounting. Let's see how GST affects each and every aspect of your business. So before we dive into the section, if any of you have any questions, you can always put them inside our chat box, and then my friends here, they would be able to answer your questions. So we are going to begin with sourcing. When we talk about sourcing, it is all about procurement, the purchases that we make for our business. So whenever we purchase goods from a manufacturer or a supplier, we pay the tax associated with it. And then when we make a sale, we collect the tax associated to the price of the product. And while making tax payments to the government, we also claim an input tax credit for the tax we paid during purchase. But then this is not always possible. Why? Because today we have a fractured input tax credit mechanism, meaning you don't get credit on every tax that you pay. To understand this better, let's take a look at an example. Let's say you are a trader in Maharashtra who buys products from a local vendor who is also located in the same state. So now you do that by paying the Maharashtrian VAT. And then when you make a sale to a local customer who is also located in Maharashtra, the customer will be paying you the Maharashtrian VAT as well. And so for such a transaction, you would be able to claim an input tax credit. Now let's take a look at another case wherein, let's say, you find a suitable supplier who supplies quality products at a competitive price, but the supplier is located in a different state. So let's say the supplier is located somewhere else. So in that case, you would be purchasing the goods from them, let's say from Rajasthan or some other state, and then you would be, while making the interstate trade, you would be paying a CST, an octroi, and then you would have an array of local body taxes, and then you would be selling it to a customer who is going to pay the Maharashtrian VAT. So in such cases, you are going to be faced with a situation wherein you won't be able to claim input tax credit. Why? Because the CST, the central sales tax, or octroi, or any form of local body taxes, they do not offer input tax credit. Because of this reason, you won't be able to do that. However, under the GST regime, so once the GST comes into place, you will be able to claim input tax credit in the same situation. This is because GST laws are designed to facilitate unrestricted flow of credit for nearly all transactions across state borders. This is because there are fewer barriers to your ability to conduct interstate business. Why? Because under the GST, it facilitates an unrestricted flow of credit, meaning it can be an interstate transaction, it can be a same state or an intrastate transaction. So whatever it is, the moment you pay GST for any purchase that you make, let it be the integrated GST when you are buying goods from a different state, or let it be the GST, which has two components, a CGST and an SGST, while making a same state purchase. So you would be able to claim input tax credit on them, irrespective of whether you are selling it to a taxable person or a non-taxable person at a later point of time. So, and if you consider the other aspects, so this is not all the advantages that are the changes that the GST is going to bring to the table. Why? Because it also brings two more changes. Number one is going to be the fact that the number of suppliers that you have is going to increase. Why? Because under the GST, the threshold is very low, meaning the eligibility conditions for a business to register itself under the GST is low. If you take the major part of India, any business with an aggregate turnover of more than 20 lakh is liable to pay taxes under GST, and so it has to get itself registered. But then when you take a look at the northeastern India, any business with an aggregate turnover of greater than 10 lakhs, it requires itself to be registered under the GST. So because of this, you are going to find more and more suppliers, more and more number of businesses registering themselves to the GST. And so you have more registered suppliers. So now why do you need registered suppliers? Because only when you purchase your goods from a registered supplier, you would be anyway paying taxes for that purchase, and then you would be able to claim input tax credit. So that is going to increase the number of suppliers that you have, and you would also be able to identify any form of blacklisted suppliers or any defaulters who are losing out on their taxes, or who are not transferring or allowing you to claim input tax credit. The next change that the GST is going to bring to the table would be the removal of all those interstate trade related taxes. So like central sales tax, octroi, and other local body taxes. So those are going to be subsumed, and they are going to be brought under the GST, and GST is going to replace them. And so because of this, the boundary disappears. And so due to both of these changes, it's going to be much easier for you to shift your business from a tax efficiency point of view to an operational efficiency status. So now let's take a brief look at what you can expect in terms of sourcing under the GST. So when you talk about sourcing, you're going to see lower sourcing costs. Why? Because of the fact that number one, you're going to get tax refunds on pretty much every kind of transaction. And number two, the excessive amount of interstate trade taxes like CST, octroi, those are going to disappear, and instead you are going to have one IGST sitting on that transaction. So it's going to bring down your sourcing cost. And then you have more registered vendors, which is going to allow you to source from taxable vendors, and then you have those tax benefits. And then you have more feasible interstate trade, and we know why. And due to unrestricted flow of credits, it's easier to just pick your vendor and do business the way you like it. Now, what do you need to do? So we know what we can expect. We have to now see what we are required to do when it comes to sourcing. And so the first thing that you have to bear in mind that it is good to source your goods only from registered suppliers, because this way you are going to be getting more tax refunds when you make those transactions. And you have to avoid blacklisted vendors, meaning those vendors who may not be submitting their returns on time, or who are defaulting in some way, because if they don't do so, then when you submit your returns, there is going to be a mismatch because you have submitted them properly and the vendor has not, and so it's going to be troublesome. Then source from manufacturers or producers directly. This is because the feasible interstate trade is now going to allow you to cut down the middlemen. So these are some of the things that you can do, or it would be useful for you to do under the GST. So with that, we come to the next section, pricing. So in the previous section, we came to know that the GST allows for an unrestricted flow of input tax credits for registered users. This means that the tax you paid on your purchases will be refunded to you irrespective of the fact that you made an interstate transaction or an intrastate transaction. So why is this happening? So as you can see, under the GST, everything is being tracked. All the 17 and odd indirect taxes have been subsumed, and the rules and the rates are going to be uniform throughout the country. So it's easier for the tax authority to allow you to get refunds. So that is why we have an unrestricted flow of credits. And if you are a supplier, okay, if I supply items that are taxable under the GST, then yes, that the unrestricted flow of credits would actually be useful to me. What if you are a businessman who sells zero rated goods like food grains? So in those cases, even you have a advantage presented to you here. Suppliers of zero rated items can claim tax refunds on business expenses, and you don't have to charge GST to your customer. So even you have an advantage. So because of the above 2 points, one being the unrestricted flow of credits and the other one being able to claim refunds on business expenses if you sell nil rated items, so you now have a choice of either giving more competitive prices by reducing your prices, or you can still increase your margin by maintaining your old prices. So you have a choice now. That said, you can no longer rely on conventional promotions. So even though you have those advantages, here is a catch. So you can no longer rely on promotions wherein you give out freebies with your items, or by promoting a buy one get one free scheme. Why? Because now under the GST, supply of goods or services, even without consideration, will attract tax. It does not matter whether the customer whom you are selling the product to is a taxable person or a non-taxable person under the GST. The customer is required to pay GST even for the freebie item given to them. And if you are wondering, okay, the value of the freebie, let's say you declare it as 0, then how will they charge GST to it? Well, the GST for the freebie will be calculated based on the market value of the free item, and hence you need to find newer ways to promote your products. So with the removal of having tax upon taxes, so tax cascading is going to be removed, and with the prevalence of uniform tax rates throughout the country, this can potentially drive prices lower than what they are. That said, if the GST rate for a particular item is greater than the current rate, for instance, if you are a service provider and you provide taxable services, in that case, currently you would be associating a 15% service tax to any service that you offer. But under the GST, if you take a look at services, it's going to be 18%. So it's going to fall under the higher end of the standard rate. So obviously, the prices associated to taxable services have to increase if you wish to preserve your margin. So this is what we have with respect to pricing. So now let's dive into logistics. So let's say you are taking a road trip and you're traveling from one state to another through the national highways. So what do you see on the national highways? So when you pass through those state border checkposts, you would be seeing a long line of trucks waiting near these places. So if you are a businessman, or if you know why they are there, you would be familiar that these trucks are actually waiting to get themselves checked by the local authorities and tax authorities in order to make sure that they are compliant with the tax regulations across the different states. So even though this is a necessary process, this is a very time consuming process. It's going to take a lot of time. In fact, it takes studies say that it takes up more than about 40% of a delivery truck's transit time, and that is a lot of time spent upon tax compliance. So for those of you who are wondering why they are spending so much time over there on a check post, as you know, with the current indirect tax system, each and every state has its own rules and regulations when it comes to taxes. And so because of that, they do not have any other means of checking whether the businessman plying goods across different state is following their rules or not. And so they make trucks wait at each and every check post, and then they carry out those inspections, check the paperwork, and see if they have paid all the local body taxes and all of that. This is a necessary process, yes, we all agree. But then, how many times have you had this awkward moment with your customer because you were not able to deliver goods on time due to the fact that your truck had to pass through a bazillion checkposts before reaching your local distribution center, or your customer directly? Well, some of you might have experienced that. Well, the good news is it's not going to happen anymore. Why or how? Well, these checkposts that were causing trouble for us, they won't be necessary anymore, because the GST will subsume all of the indirect taxes. And so it's going to, as per estimates, it's going to bring down the freight time by 20 to 30%, and it's going to cut down logistics costs by another 30 to 40%. And so you can expect lesser roadblocks, lesser checkpoints, and other stoppages. And so this is going to be speeding up your delivery process, so you can fulfill your orders faster, and you don't have to rely on multiple distribution centers across the nation. And so what can you expect in terms of logistics under the GST? Well, as we saw, we can expect reduced freight time and costs. And so because of the reduced freight time and costs, because the checkposts are going to be lesser, or even though they won't disappear completely, they are not going to take up as much time as they are taking up right now. And so because of faster deliveries, you can also source your goods faster. So you can just place an order to your vendor and it will reach your warehouse faster. So because of this, you don't need a large inventory, so you can cut down on the inventory that you are maintaining. And so this can also reduce your operational costs or your maintenance costs. And because of uniform tax rates and rules, it's going to be easier for you to comply with it throughout India. And you don't need a specialized crew who specialize in taxes just to prepare the paperwork for your deliveries. So what do you need to do under logistics? Well, you can now promote interstate trade over imports. So instead of going for imports, in fact, you can just tap across the different micro markets that we have within India, and you can improve your presence into the other state markets. You can do that either by having shopping carts online, or you can go for outlets in those places. And due to faster deliveries and due to the ease of operations, you can cut down the inventory held by you. So that is going to save you some space, and you can probably stock up with more variety of goods. And then, because you are cutting down on the inventory that you are having, you have to maintain reorder levels and minimum order quantities for your items more judiciously, because you need them in order to always have the optimum stock available. And in case you have large orders, so previously you might be stocking up for fulfilling large orders, so in such cases you can now rely on drop shipment or back ordering your items. And due to faster easier interstate trade and faster movement of trucks, even that is not going to be a hassle. And if you're worried about any deliveries delays in deliveries made by your vendors and such, you can probably go for some sort of advanced shipping notifications or some sort of RFID tagging which would help you to track your package, and that's going to help you to keep your customer informed. So that is with respect to logistics. And so we are going to take a look at distribution. So as India becomes one large market, there will be fewer restriction for goods to move across different states. So in the current business model, when a sale is made to a distributor in another state, a non-refundable central sales tax is applied to the goods. So as you know, we have an array of interstate trade taxes when you're going to directly sell to a distributor in another state. So in order to avoid this, either the distributor is going to have a warehouse in your state, or sometimes if you have multiple distributors in a target market, then you might have a warehouse in that particular state. You as a wholesaler or you as a manufacturer might do that, and you would be using a hedge form, and then you would just transfer your goods to that warehouse, and then the distributor can source this easily. So this way you just convert this troublesome interstate trade into an intrastate trade. And this way, not only you but even the distributor can claim an input tax credit. But then this comes with a cost. So what is the cost here? Because you are going to set up some sort of distribution centers or warehouses in across different states, irrespective of whether you are a distributor or a manufacturer. And so your operational costs and holding costs are going to go up, because you have to employ manpower, rent some space or buy space, have the infrastructure developed for it, and then you have maintenance, and then you have an array of taxes associated with any storage facility. And so that's going to add to another layer of expenses when we talk about it. And so under the GST, this practice of building a warehouse in every state will not be necessary, because you're going to have a uniform tax rate structure across the entire country. And because of that, and you also get input tax credit on even interstate transactions, so you no longer have the need to have that extra layer of warehousing across India. And also there is one more reason as to why you need to consider not having multiple distribution centers across different states. That would be because of the fact that GST does not distinguish between supply to oneself as well as supply to a third party. So under the GST, it does not matter. It can be a stock transfer or it can be a sale. Irrespective of whether what kind of transaction it is, you still have to pay a GST for that, even to move goods between your own warehouses, which are just located across different states. So due to these couple of reasons, you should actually consider consolidating your warehouses, and instead of having multiple small warehouses, you just have to move into a tax neutral environment and then set up a larger warehouse wherein you can outfit the entire country easily. So what can we expect under distribution? So you can expect a unified market. So because of unified laws and uniform tax rates for every category of product, it's going to be easier for you to move substances and to make sure that your transactions are compliant with the taxes across India. And then you have GST on supply to self. So even if you are transferring stock from one warehouse to another, if you're doing it from, if your warehouses are located in the same state, then you have no problem. But if those two warehouses are located across different states, say one in Rajasthan, one in Maharashtra, in such a case you would be facing a GST associated with that transfer. And then you can expect consolidation of warehouses. So because of the reasons, you would be expecting more and more sellers, even your own suppliers, you would be seeing them cutting down on distribution centers and going for larger storage facilities. And as you are removing a layer of multiple supply depots or distribution centers in your supply chain, it's going to reduce your operational costs. Okay, so what do you need to do? So basically it's all that we discussed. So you have to start by removing your layer of secondary warehouses, which were initially set up to convert an interstate trade into an intrastate trade. So all those warehouses which were basically set up for tax efficiency, they are no longer needed, and you have to actually focus upon going for a centrally and a strategically located warehouse in a tax neutral environment, wherein you can not only save up on taxes, but it will also be easy to outfit many markets from that point. So say in some place like say Madhya Pradesh or some in some centrally located state, if suppose you still need distribution centers in different states, in that case going for a consignment model or a sales or a barter model over stock transfers would be more beneficial to you. So you can even tie up with a local dealer, and instead of having a warehouse of your own, you can just barter or exchange the stock of items that you have between the both of you, and then you can tap into both the markets. So something like a consignment model would be more beneficial to you. So with that, we come to the last section of the webinar, wherein we are going to talk about accounting. So since the GST is a complete overhaul of the existing tax system, you can expect quite a bit of changes in your financial compliance requirements. And this can extend well up to keeping track of different components of GST, like having separate entities for interstate trade and intrastate trade, and then you have to have additional accounts inside your chart of accounts. And then it also brings to you newer ways of calculating taxes. So you are no longer going to rely upon the current method of having different taxes, compound taxes, etc. So you just have three factors here: the IGST, a central GST, and a state GST. So before we dive into it, let's see what you are required to do and what you can expect from the new tax model. So first up, you are required to recategorize your goods or services that you offer into four tiers of GST. So under the GST, we know that there are four different tiers, starting from the zero rate, which nil rates your items. Then you have a lower rate of 5%, and then you have two different standard rates, one at 12% and another at 18%, and then you have a higher rate of 28%. So depending upon which category of goods you deal in, or where the items that you supply or the services fall into these tiers, you would have to recategorize your goods and services. While there are no changes to tax associated with certain types of products, so for instance, those who sell food grains, so it's going to stay nil rated, or any of the different items in the CPI basket. But then if you are selling items like, say, electronics or processed goods, or any form of let's say you're supplying taxable services, in those cases these items are now going to be associated with a new tax rate. So previously we talked about, when we were talking about sourcing, so or and the pricing structure, we talked about, the tax rate being higher for services. Tax rate for services is currently at 15%, and it's going to raise to 18%. So in that case, you have to change the pricing model upon the things that you have. And your invoice format might also need a few more changes to accommodate GST requirements. So now that you are registered to GST, you are going to be getting a GST IN, something like a GST pin, which is going to be unique to your business. So you need to have that displayed upon your invoices. And then the invoice serial number should also be unique for a particular financial year. So it should be considered just like some sort of a serial number in its own accord. And you're going to also change the way in which your invoice look. So instead of different taxes sitting upon your invoice, you're going to have GST right over there. And since interstate sales or purchases and intrastate sales or purchases are taxed differently, you need to keep track of them separately. And this extends to tax components as well. So basically, when you talk about GST, especially when you are buying and selling goods across different states in India, you know that you have an integrated GST sitting upon those transactions, and so it has to be tracked separately. And then for a same state trade, so if you are buying and selling goods within the same state that you are located in, you would know that a normal GST is going to be associated with this transaction. But then this normal GST will have two different components. So it has a central component, meaning a CGST, and you have a state component called SGST. So both of these are going to be applying to your regular transactions, and so you have to keep track of your IGST, CGST, SGST components separately. Currently, organizations do not get tax refunds upon certain taxes like luxury tax, octroi, and entry taxes. So while transitioning into the GST, these taxes are going to be subsumed under it, and you are going to get refunds even for such transactions. And now that the refundable taxes are not to be considered as a part of your actual cost of acquisition of goods, so they have to be actually accounted as assets rather than as an expense. And you need to reconfigure your inventory valuation and your expense recording rules based on this change, so that your tax credits are kept track of properly. In addition to this, you might also have to update your chart of accounts. So now that the GST is going to replace the current indirect taxes that you have, the way in which the older tax accounts or the obsolete tax accounts within your chart of accounts have to be removed, and then you are going to add newer ones which are related to the GST. And while you're making all of these changes, please make sure that you carry out detailed assessments from time to time, and so that there are no financial reporting errors. So even though all these compliance requirements can set you back initially, if you start well ahead of time and make provisions to handle all of these in your accounting system, it's going to be possible, and you can pull through this without having any problems. So you just have to carry out audits and assessments periodically while making the transition, so that you are in line with the changes that are coming to the table. So with that, we come to the end of today's session. To summarize, the GST will widen your sourcing operations, and it is going to give you more and more suppliers because of the low threshold. and it's going to allow you to offer more competitive prices due to unrestricted flow of tax credits, and it's going to lower the cost of your logistics operations because interstate trade is going to be uniform. All your cargo delivery as well as cargo sourcing is going to be faster, and then it is going to simplify your distribution network because it's going to remove a layer of unwanted supply chain distribution centers that you have, and then it's going to improve the transparency of your books. So if you have any questions, drop us a mail to support@zohobooks.com. So once again, I'm your host, Ajay Aditya C, and I thank you all for being here and making this a success. Take care. Bye bye. Thank you so much. And I wish you a fantastic future ahead.